We have results analysis ahead, and we will want your comments on those companies as well. Zensar Technologies posted a mixed set of Q4 earnings. The company saw strong revenue growth, 4.15% sequentially, and order wins robust, coming in at over 160 million, but margin continues to trend lower. Ajay S, Bhutoria, the Managing Director and CEO of Zensar Technologies, joins us now. Ajay, good morning. First, the difficult part, the margins that are under pressure. Can you tell us a little bit more about what pressured? Is it attrition? And is it peaking off the attrition? Are the margins bottoming out? What's the guidance?
Sure. So, Lata, yes, the margin pressure that we got into a couple of quarters back was largely driven due to attrition. It was at an unprecedented high. I spoke with you the last time. Global phenomena further exacerbated in the case of India. What we see in terms of attrition is that for our company, the in-quarter attrition for the last quarter actually dipped over the previous 3 quarters. So that's a good sign. And then we put a bunch of measures in place, which will play out over the next 2 to 4 quarters in terms of addressing the attrition and addressing the margin issue overall. And those levers, which we put in place a couple of quarters back, have demonstrated green shoots in terms of reducing our cost of delivery.
Okay, all right. Hi, Ajay. Good speaking to you. In the last quarter, you had guided, more sell side that you're expecting margins to gradually move towards the high teens. Now you're in the mid-teen mark on. So sometime of this year, do you think that high teens is possible? Maybe the second half of this fiscal? Is that a target you have in mind?
So the way we see things evolving over the course of next few quarters is that we will hover around this range, around the mid-teens. And our objective is that in the medium to long term, we get back to the high teens range that we wish to, from a long-term perspective.
It could be, is it your strategy as well to concentrate on revenues where the going is good rather than worry too much about margins? And if you can give us a little more color on the kind of orders you have got, are they coming with a better price tag, billing?
Sure. So Lata, good quarter from an order booking perspective. And we see this order book rise across all different service lines and natures of contract. So both in terms of discretionary spend as well as in terms of some annuity business, etc. So overall, the spread of the order book has been good. We put a new strategic framework in place about 4 quarters back with an objective to drive predictable, sustainable, and profitable growth. And what we've seen is that the focus that we put on execution is beginning to bear good, strong results. The first couple of quarters, we saw green shoots. Now we believe that we are firmly in the groove. And over the course of the year, the strength of the franchise has significantly gone up. So what we're going to do in the future, in the coming quarters, is continue to drive on this execution and continue to build resilience while making sure that we hover around the mid-teens margin.
Ajay, for the last year, you've done around $570 million approximately in terms of revenues, which is a good 12-13% growth in comparison to the previous year. However, if I compare that revenue number with FY20, it's still a little bit lower. For FY23, what kind of a revenue growth number are you looking at? Double digits or is it mid double digits? Go ahead.
Sure. So if you look at this, financial year 22 that we just closed, the revenue number like for like, so if you exclude the divestitures that we've done, the revenue number like for like is the highest revenue that we've had at 569.4 million. What we saw as a part of this revenue is not just the annual increase of around 15.3% between FY21 and FY22, but very significantly, the other metric that we very closely watch is quarter-on-quarter improvement between Q4 FY21 and Q4 FY22. And that number grew by 27.4% company-wide. And that growth was broad-based across all geographies, all service lines, and all verticals.
What's the guidance for this year? I mean, what kind of a number are you looking at?
So what I can share with you is that, like I said, early quarters, green shoots, firmly in the groove right now. And our laser focus is continue to drive that execution and continue to build resilience.
But you don't want to put a number to that, Ajay?
I mean, at least above that
Unfortunately
589.
we don't give guidance out, so
No, do you
what I can tell you is that
do you better FY20 is what we're at least trying to get.
Yeah, so 4 quarters of growth, strongly in execution phase. We feel good about how the order book is shaping up.
Okay.
Overall, the business metrics are good.
Okay.
Fair enough.
All right, you're sitting on some cash as well. Final question, Ajay, of around what, $160 million approximately. What are the plans to utilize it? Give some money back to the shareholders, or do you have some inorganic growth plans?
So both. We just announced a fairly attractive dividend. So give some money back to the shareholders. We are zero debt, and this is capital that's available for us for application, including for M&A. We continue to watch over that space very carefully. We continue to evaluate a lot of companies, and at the right time, we find the right buy, we will announce another acquisition.
Okay. All right, we will leave it at that. Thank you very much, Ajay, and all the very best for FY23 as well. Okay, Girish is still with us. Girish, I know we started by discussing the mid-cap IT stocks, but what's your pick of the pack?
So as I said, we have sell on almost all the tier 2 IT stocks. So we wouldn't kind of bet on them. So we've had a situation in the last 18 months where the digital high tide had lifted all boats, and including some of the weak ones. And the multiples of the tier 2 stocks have kind of risen to levels where they are probably trading at about 30% premium to the tier 1 PE multiples, which I don't think are sustainable. I should just put this in comparison to what they were in January, on 1st of January 2023 pandemic. That was like a 15% discount to the PE multiple of tier 1. So we've seen a significant PE multiple expansion. So I wouldn't want to put any money in tier 2 stocks right now. As I said, we are pretty cautious on the market. We think that one should be looking at making money. It should be more in terms of preserving capital. And from that perspective, we would say, if you want to put money in IT, I would say tier 1, where our preference would be like HCL Tech, Infi, and TCS. That would be our picking order.
At least there's some valuation comfort here. Girish, stay on.